Good evening. It is Wednesday, March 6th, and we're live from Maritime Resident Doctors World Headquarters here in Halifax for Mardocs Talks Live, and it starts right now. Thanks again. I do want to welcome everybody in on this lovely winter night, I guess we'll call it, for our fourth edition of Mardocs Talks Live, and it's March. And we're driving towards spring, and that means a few things, but one thing it certainly means is it's tax season. So this year we decided to try our annual tax tips session in our online Mardocs Talks, and we appreciate everybody joining us tonight. So I'll introduce our guest in just one second, but first I'm going to give my usual disclaimer. Maybe this is your first Mardocs Talks Live that you've joined us for. I just want to manage our expectations a little bit. There's nobody here in the room tonight except for myself and my guest. We don't have a producer. We don't have one of these slick setups for our live streams. It's just myself, my guest, and a computer. So you'll see me milling about over here and just trying to take care of things. And if we run into technical issues, we'll deal with those as they come. But we hope to have a good time tonight for about the next hour or so, talking with our guest about taxes. Questions. I know you've got them. I've got a lot of questions about my taxes, so how can you get them in? We can type into the chat on YouTube. I'll be perusing those. You can email me, daniel@mardocs.ca. I'll check that as well. Some people sent in some questions in advance, and that was fantastic. And what we're going to do tonight is we're going to have a prize, because since it's tax season, we could all use a little more money. We've got $50 Visa gift cards. We're actually going to give away 3 for this special edition. So everybody who joins us online and everybody who asks a question, so if they asked a question in advance, they couldn't make it tonight, they're on call, they're going to be in the draw as well. So for all you folks who've joined us online, maybe you're not sure yet if you're going to ask a question, to be sure that your name gets in the draw, just type your name into the chat. You don't have to ask a question, just your first and last name, and then we'll check that later on to do our draw and be sure that we don't miss anybody if you're going in or out. So with that, I think it's time for us to bring in our guest for the evening. And to my right here is Mr. David Hall. Thanks for joining us, David.
Oh, it's a pleasure to be here.
So David is a partner at Flaim Wolsey Hall Chartered Professional Accountants. And for those of you who aren't familiar with Flaim Wolsey Hall, they're a physician-focused group. And right off of your bio on the website, David, it says, David works primarily with new doctors that have just completed their residencies to help them set up their corporate structure in the most efficient way. This allows doctors to reduce their income taxes and build wealth while paying off student debts. David provides accounting and income tax advice in a clear, understandable fashion and has over 20 years of experience in public accounting. So, as I mentioned, your firm does focus on physicians, David, so maybe you can just tell me, as an accountant, what are physicians like as a group to work with? That must be an interesting group.
Yeah, they are a really good group to work with. They, you see lots of folks with lots of different issues that come through the door. But again, I find that as a group, most physicians are pretty appreciative of the help that we get, and certainly for a physician, taxes is a pretty significant expenditure each year. So anything that we can do to help folks minimize that, seems to help a lot. Absolutely, and I know you've partnered with us on this presentation for a number of years now. Yeah. It's a little different setting this year, but it'll be good. I've got some repeat information and some new things this year, so hopefully folks can pick up a thing or two.
All right, fantastic. And so just again to set the table here, we're going to let David run through a presentation first. Lots of tips and tricks that might be new for new folks, or might be a great refresher if you happen to check out the presentation last year. If you have any questions at any time, you can just fire them into the chat, or you can email daniel@mardocs.ca. And we'll just interrupt David and get right in there. We'll also have a rapid fire right at the end for any burning questions, because we want to be sure that you take this opportunity to pick David's brain, because here he is, and he's giving up an hour and a half of his time here right in tax season. So let's take advantage of that. So I think without further ado, maybe we'll start with our presentation. And folks, just remember, fire your name into the chat and any questions that come up. So here we go. David, you can take it away.
Okay, thank you. The presentation tonight will cover off different types of income and deductions and credits for folks, and also perhaps some benefits that people may want to try and realize through the filing of their tax returns.
Okay, great.
So we'll dive right in. So as I said, we'll talk about common income types, deductions, credits, and just one slide at the end about incorporation. I think the group here can be at different stages of their residency, so hopefully there's something for everybody, and if you're close to the end, we'll just have a really brief chat about incorporation, and certainly able to answer more questions sort of offline if folks wanted to do that, or even meet or have a phone call.
Okay, great.
Yeah. So for most folks, you work through your medical career here, and you have some different phases that you go through. So starting off as a medical student, for most folks, you're in school, don't really have any income, lots of tuition and expenses, so we get tuition credits for those. Most folks would file a tax return and certainly have no taxes. And then also, around this time, you're starting to see student loans and lines of credit. Get through medical school, and now we start off, you start to have some income. And so, most folks would get a T4 for that. They would continue to generate some tuition credits each year as they continue their studies. May have some employment expenses. I want to talk a bit about that later. The government has taken steps to reduce the expenses that folks can claim. And as you get later on in residency, you may have some self-employment income from locums, moonlighting, that kind of thing. Generally what I find is folks won't have any taxes owing. For the first couple of years, we'll often have large refunds, but then if you get into some self-employment scenarios, may have some tax to pay. So beyond residency, some folks go on to do a fellowship. What I find there is that income is generally received not as a salary where you have taxes deducted, but if you made $60,000 a year doing a fellowship, you get the full 60 and you're responsible for the tax. So you want to be careful there. You can get yourself into trouble if you don't do things properly. And then, of course, when folks are done, become a practicing physician, what I find there is most folks are self-employed. You get the odd person that is an employee, but that's rare that we see. And so now I'm into, again, I'm responsible for my tax. I'm responsible for keeping track of my income and my expenses. So can't stress enough that you want to be organized and make sure you're timely to do things.
Great.
Yeah.
I'll just jump back in for one quick second, David. I did want to say to the folks watching us that this is the first time, especially if you're one of our longtime viewers and you've watched all 4 episodes. This is our first time using a PowerPoint right directly into our presentation. So let us know if we run into any technical issues, anything else with the audio or anything. I obviously have a hard time to know if it's happening unless you guys let me know. So just let me know that if there's any problems, and then I can work in the background here and then keep the questions coming in. That's great. So back to you, David.
Thank you. Next slide. So first tip, I guess, for folks is to make sure that you file a return every year. As a student, you don't have any tax to pay, but again, when you file a return, that's when the government becomes aware that you have tuition credits. You don't necessarily use them in the year that you get them, but they carry forward to a future year, and you can use them to reduce your tax in residency. And also, folks will receive GST, HST credits, that type of thing. So again, if I don't file the return, I'm not going to get those. As a resident, it would be important to file a return because those tuition credits that I've carried forward, now's the time that I want to use those. So if, as an employee, I've been having taxes deducted in my first year of residency, I want to use those tuition credits to either avoid having taxes deducted, and we can talk a bit about that, or to get a refund at the end of the year. And then that refund can be used to apply on a line of credit or contribute to an RRSP, let's say. So again, important to do that. And in later years in residency, especially if you're starting to do some moonlighting or locuming, you have the potential there for a large tax bill. And if you don't file a return on time, of course, then you're subject to interest and penalties. So again, really want to avoid that. Hate to pay those to CRA.
For sure.
So folks are aware, April 30th is the deadline for folks to file a personal tax return. That's if you are an employee. So early years of residency, if you don't have any self-employment income, basically April 30th is your date. June 15th, if I have self-employment income, the government gives you basically an extra 6 weeks to be able to calculate your income and file your tax return. You won't get a penalty if you're self-employed and you say file on June the 1st. And so they give you more time, but the interesting thing is if you owe tax, they start to charge you interest after April 30th. So practically speaking, we work to an April 30th date for everybody, and just to make sure that it gets done. Penalties if the return is filed late, and so they can add up. It's 5% of a balance owing and plus 1% for each month that you're late with a balance owing. It tops out at 17%, so they charge you the 1% for a full year. And so again, you know, if you happen to owe $10,000, then you're into a $1,700 penalty in that case. So that's the first time. Second time, they double the rates. So again, really want to avoid that. And of course, if you have a refund, there's no penalty for late filing because you don't owe anything. But again, if you have a refund, you want to file your return to be able to get the cash back.
Absolutely.
So employment income, this is fairly typical from what we see. You know, somebody comes in, they perhaps have a T4, you know, for $65,000 to $90,000. And from that, there'd be CPP, EI, taxes, dues, that kind of thing deducted. And so, you know, folks would have net pay in this example of $48,000. Life is relatively simple here. You know, your taxes have been calculated for you, deducted, sent into CRA. I get a T4 slip, and I file that at the end of the year. Typically, the health authority is pretty good at calculating tax, so most folks would not generally owe a lot or have a large refund, and so, you know, it's fairly straightforward. Next slide. So, as an employee now, we want to look at what can we do to try and reduce our taxes, and one of the things that we want to do is make sure that we can deduct any expenses from our employment income. And the presumption here is that as an employee, generally the employer will pay most expenses. So under the Tax Act, the rules are fairly strict around what employees get to deduct, and also around documentation around what do I need to provide to CRA to show that I could deduct these expenses. So some examples that people can claim is mileage. So if you're driving from one work location to another and you're not being reimbursed for that, you basically want to track those kilometers and make sure that at the end of the year that, you know, this was a cost that I incurred to earn my income, and to be able to claim that on your return. Cell phone is a big one, and up until 2015, we had been claiming that for clients and really had no issue. And it seemed in that year that CRA turned its attention to employment expenses, and in particular cell phones. And so that year we probably prepared 60 to 70 returns for residents. And we were about 100% that we had claimed cell phone, and we were about 100% that they had been denied. So that was the first time in our practice that we had seen that. After that tax season, we had reached out to Capital Health to say that, you know, you guys had been providing a form indicating that residents had been required to carry a phone, and just to let them know what had happened this past tax season. And so the logic that CRA used around the cell phone was to say that, look, the phone bundle here is a package. There's, you know, you may pay a fee each month. It includes, you know, access to the cell network, data charges. You know, you may have a package where it's unlimited talk. And CRA said, well, there's really no way to distinguish between work and personal use in that case and break the cost down. So their position was that they denied the claim. And so I think enough folks had contacted the health authority to say they had had issues around that. And I think it was last year basically that the health authority had indicated that we're not going to provide these forms anymore for people saying that you had to have a cell phone. So unfortunately, that's one less deduction that people have there. Other items that folks generally deduct were any union dues or professional dues that you needed to be able to work. I found the Mardocs dues, those are indicated on your T4 slip, so we get those just from that. But other folks might have like a membership to the college or something like that that we generally claim. Folks have to have CMPA here to work, but generally if the employer has reimbursed you for the CMPA, then you can't really claim that as an expense on your return. And also in particular, if say in Nova Scotia and PI, we're sort of the odd provinces here in that in any other province you can claim CMPA without a form from your employer indicating that you need to have CMPA to work. Here in Nova Scotia, you do need the form for that. So if you find yourself as an employee and having to pay CMPA, you will have to get that form from the health authority. Self-employment income. So generally CRA will treat self-employment income a little differently than employment income. So the presumption here is that I'm carrying on a business, and it's really up to me how I do it and the costs that I have to incur to be able to earn that income. So there's much more latitude to be able to claim expenses. So for example, if folks were moonlighting and let's say they went to a different location and they had accommodation cost or travel cost, generally you keep track of those, and we claim those on your personal tax return each year. You don't really need that form from an employer to be able to do that. The one thing I would say again here is you want to be careful around record keeping. So from the point of view of you want to know how much income you've received, and so generally what we're looking to do there is to say, hey, I've made $1,000 from moonlighting here. Not all of that money is mine. I'm going to have to pay tax on it. And generally what I would say to clients is, look, set aside 40% of what you see coming into your bank account, move it off to a savings account, or even better, park the money on your line of credit. So take that 40%, don't spend it, put it on the line of credit, and at least save the interest on the line of credit until April 30th of the following year, when you'd need to draw the line of credit to pay your taxes.
That's great. Maybe we'll give David just one moment to catch his breath there, and I see people coming in the door and out the door, so I just thought I'd take a moment to reset and just say welcome. Thanks for joining us for our Mardocs Talks live here on Tax Tips on this lovely winter Wednesday. If you've joined us, you're going to be in the running for 3 $50 Visa gift cards that we'll be drawing for later on. All you need to do to put your name in that draw is just type your first and last name into the chat. You don't need to ask a question necessarily, just fire your name out there, and then we'll use that as our list later on that we're drawing from. As well, speaking of questions, you've got questions, let's get them answered tonight. So you can just type any questions you have into the chat. You can send emails to daniel@mardocs.ca, and I'll be happy to look through those. And we'll just hit David up with any questions as they come, and then otherwise at the end we'll have a nice big scrum as well if there's anything that David didn't get to.
Certainly. So
we'll go back now and continue hearing what David has to say after I bring it up on the screen. There we go.
Chatted a little bit about this. So basically, here really what we're looking to do is to make sure that you're able to claim all of the self-employment deductions to which you're entitled. So threw up some examples there of what folks may have to pay out of pocket. So if you have any extra dues or fees, vehicle costs, accommodation, meals, conferences, fees, I find folks, once they get to later years of residency, they may go on some extra courses, so generally we'll claim that against the self-employment income there. And interestingly, cell phones. So when CRA looked at the cell phone costs for employees, they really targeted on employees and really did nothing with folks claiming cell phone costs on their self-employment against their self-employment expenses. So we've continued to claim those in 2016-17 without any real issues from CRA. Also want to stress again, keep receipts for your expenses in case you need them. CRA could come looking for receipts for up to 6 years after the end of the tax year, and keep a logbook for business use of a vehicle, or use a phone app also to keep a record of your driving.
Great.
Other types of income that we generally see folks with residency, you'll often receive a scholarship or a bursary, so most folks in residency will have a T4A reporting some sort of assistance, and generally those are tax-free. So we report them, but there's no tax on scholarships and bursaries, provided that you're in a program that leads to a diploma or a degree. Okay. So that leads into, say, the fellowships. Folks will receive funding for that, and really, unless the fellowship leads to some sort of extra degree, the income is taxable, unfortunately. So, and last one here that we'll often see folks, perhaps with kids, they'll have a Canada Child Benefit, and that replaced the Universal Child Care Benefit a couple years ago. The old program was taxable, the new one is tax-free. So, you know, again, folks generally will receive that and don't even get a tax slip for it.
That's great. We have our first live question of the night, in addition to the many that we already have up on the queue. Olga asks, what can you claim under vehicle costs for self-employment?
Yeah, so generally the vehicle costs are the cost of the car. So if you bought the car, we would want to know how much you paid for it. And generally you don't get the full price, but you get to claim a portion of the cost of the car, so they depreciate it, let's say. If you've leased it, we'd want to know the leasing cost. And then the operating costs for the car, so any fuel, maintenance, licensing, insurance, that type of thing. And so the what you end up doing is you track all of those expenses in the year, we add them up, and then we say, well, you drove 20,000 kilometers in the year, you drove 2,000 kilometers for work, and so then we take 10% of the cost and claim those on your return.
Oh, great.
Yeah.
All right, excellent. And Olga also had a second question here. Is there a limit for the number of conferences that can be claimed each year under self-employment, and what can be claimed under the conference category?
Yeah, so generally there's a rule around conferences that CRA says, look, you can go on conferences, but it's really 2 per year. Okay? And so we don't often see people claim more than 2. And in terms of the expenses, it's really anything that you had to pay to get to that conference. So it would be the conference fee, the accommodations while you're there, if you're out of pocket for meals while you're there, you know, airline cost, ground costs, say, for a cab to get from the airport at the conference city to the location, and travel costs even from your home out to the airport here, say, if you took a cab.
Great.
Yeah.
All right, excellent. Well, we'll get back to the slides, and we've got lots more questions coming later on, for sure.
The Canada Child Benefit, I do encounter people that are in residency and have kids. Always amazes me that folks have time. But so just generally some comments around that, the 17 years. And what happens is CRA looks at that benefit, and then when you file your tax return each year, they say, what was your income? And if it was more than $30,000, they start to reduce the benefit. Okay. And so it gets reduced over time, and generally what I find is if folks had $150,000 of family income, you know, it's down to perhaps a couple $100s. And so it's good, especially if folks have multiple kids or say are at a lower income. It can be pretty significant. If you do have kids and not been receiving the Canada Child Benefit, there's 2 ways to go about doing that. You can apply through the CRA My Account service if you're set up for that. And if you're not, then there's a form that you can download. It's RC 66, so you can get that online and then submit it to the location where they say on the form. And then once you're receiving the Canada Child Benefit, in order to continue receiving it, you want to file your tax return each year, because again, they do that income testing, and if they don't know what your income is, they don't give you any benefit.
Mm-hmm.
Yeah.
Okay, great.
Other deductions for folks with kids. So again, kids 0 to 6, you can claim up to $8,000 per year, and then kids 7 to 16, it's $5,000 per year. And so generally the obvious ones are daycares, so track those, or preschools. Summer camps would qualify if they're a week in duration, let's say, and there's lots of supervision for kids. So the example I give is if you had a 5-year-old who's in, say, a soccer camp for a week, they're supervised for the week and taken care of. Mm-hmm. That's a different thing than if you had, say, a 16-year-old who's in a sports camp where they're sort of working on soccer skills. So at that point, really, probably don't claim the camp. Okay. And then with childcare, it's the spouse with the lower income that would claim that.
Okay.
Yep.
Great.
One we see a lot for folks during residency is you're in medical school in one city and maybe going to another center to do residency, and then when you're done residency, you may be moving somewhere else. So in order to claim moving expenses, you have to be 40 kilometers closer to your work location. So if you're in the West End of Halifax and you move closer to the hospital, you really don't get any benefit for that. So there is that test that you need to meet. And generally for moving expenses, there's cost to get you and your things and your family to the new location. And folks may have, say, cost to cancel a lease, or if they've, say, purchased a condo where they're doing residency and now they're looking to relocate. If it takes you a while to sell that, you can claim costs such as mortgage interest and utilities and property taxes while you're selling it. They put a cap on that of $5,000. And also the cost to sell the old home would include like legal or real estate commission, or a fee if you broke the mortgage. If you were selling the home and moving to a new location, buying a home, you can then claim costs to purchase the new house. So legal, and a big one is deed transfer tax. Okay. So definitely want to make sure you get all of those.
Great. I noticed that we've just gone past the top of the hour, so maybe we'll take the opportunity to do a quick little reset and just welcome everybody in who's joined us tonight for our Mardocs Talks Live on tax tips. We've got David Hall here with us, and we're going through our presentation now. We've got a couple of more questions I'm going to get to in just one second. If you want to join the question train, all you need to do is just type them into the chat, or you can email them to daniel@mardocs.ca. We're going to start going through every question here, certainly at the end, and any that I see coming in close to real time, we'll try to get them off to David here as well, so we don't have such a rapid fire at the end. We're going to be here for another little while for sure, so you've got time. You can listen to hear what David has to say, and then let us know at the end, or just fire it in as it comes. Also remember, if you joined us late, we're giving away 3 $50 Visa gift cards for everybody who attends tonight, as well as anybody who sent a question in advance. So if you're listening to my voice right now and you want to be sure that you're in on that draw, just type your name into the chat, first and last name, that's all. And we'll use that as our list when we draw later on. Let's get to a question or two while I'm here, David.
Sure.
I have one here from Ollie who says, what are the pros and cons of not having tax taken off paycheck by employer, given that we know we have tax credits?
Yeah, that's something that I've had people do the last few years. And so there's the benefit would be if, say, it's my first year of residency after finishing medical school, okay? I have lots of tuition credits, and so on my salary, if it's $60,000 to $70,000, I'm going to have $15,000 deducted in tax. Well, really, why would I want to turn that over to the government and then have to wait until the next April to get that cash, when really I could have said to my employer, look, don't withhold that tax. I have tuition carried forward, so really then it increases your pay every single pay, right? And so that may help you cover expenses or give you income to be able to, or extra cash to put on the line of credit, right? The one thing I would say is what I find with the tuition credits is there generally will result in people paying no tax their first year working and through about halfway through the second year. Right. So let's say that you did go to your employer and have the request to not have tax deducted processed. You need to remember at some point to go back and say withhold the tax again, because at the end of the year, let's say now I'm going to have a large tax bill. Right. So not an issue, I guess, if you've been somebody who's been good at using that money to put on the line of credit because it'll be there at the end of the year. But let's say that you'd spent the money, well, now all of a sudden I have a tax bill at the end of the year, no way to really fund that. So you just want to be careful when you do that.
For sure.
The one thing I would say, it's a little bit of a process in order to not have taxes deducted from your pay. There's a form that you need to get from CRA. It's T1213, I believe. So you can download that, and basically you have to indicate the reason why you want taxes not to be deducted.
Okay. And
you send that off to CRA. They have to approve the request, and then the approved form goes to your employer.
A process there.
It is a little bit, yeah.
So we got questions coming in fast and furious now. We'll get through a couple more before we get back to the presentation. I don't want to ignore the email here, so here's one from Nadia who says, just wondering, can we claim travel for electives? So if we're traveling somewhere else for a month or a 3-month block.
Yeah, generally I guess what I would say is if it's in, say, a year when you have some moonlighting income, we would generally claim the costs associated with the elective against the self-employment income because you have more latitude that way.
Okay.
But if your only source of income in a year is employment income, then you really need to get that T2200 form from your employer. And really what that employer has to say on that form is you were required as a condition of your employment to take that elective and to travel to take that elective, and that you're not going to be reimbursed for it. So really, if you can get your employer to certify those two things and get that form, then certainly claim that as an employment expense. Generally, I find CRA will look at employment expenses, so you have to be prepared then to have that form and also to have receipts to be able to provide if you needed them.
For sure.
Yeah.
Okay, great. Sticking with sort of the travel questions here, is it possible to claim expenses related to looking for jobs? Example, plane ticket for interviews in another province.
Unfortunately, that is not deductible.
Okay.
Yeah.
And here's just a great tax question. Moving from Nova Scotia to New Brunswick, what province do I file my taxes with?
So really, when the question boils down to when you file your tax return, you have to indicate what province am I resident in.
Okay. And
CRA will look at, say, at the end of the year, where was, say, your house or your apartment or your condo, and if you had dependents, where were they, right? And then those are the primary things that they'll look at, but they'll also consider things like, did I have a driver's license, or did I have membership, say, in one province, or health, provincial health coverage, and so really I find that a residency may not be obvious, and you need to look at the factors that determine where you are a resident.
Wow.
The one thing I would say is if you are looking at relocating to a province, say from Nova Scotia, and you're going out west to Saskatchewan or Alberta, generally the western provinces will have lower personal tax rates.
Okay.
So let's say you're coming up on the end of the year and I'm looking at moving. If I'm going from Nova Scotia with the highest tax rates in the country to a province with lower tax rates, I really want to make sure that I do that before December 31st, that I get situated in that new province, because I want to file a tax return there that I'm resident. So it can have a significant impact on your tax bill for the year.
For sure.
And conversely, if I'm in a low tax rate province and I'm looking at moving and it's the end of the year, I really want to drag my feet in that case so that I'm still resident in Alberta
Yes.
on December 31st, and then I come to Nova Scotia, say, on January 2nd.
There you go.
So I ran into a case there a couple of months ago where somebody had moved from Alberta, had been an employee out there, had taxes deducted, and wasn't a resident, but an employee.
Oh, okay.
And so we calculated that just by having moved the week before Christmas, she was now going to have an extra $9,000 tax bill because she had to pay Nova Scotia tax rates.
Welcome to the Maritimes.
Yeah, exactly. So not a happy story,
No.
and but generally, I guess if you are thinking about a move like that and you're not sure, just get in touch with an accountant and just say, look, here's my situation. What should I do?
Yeah, excellent. All right, that's great. We still have a few more questions, but I think we'll get back to the presentation. I know Patricia had asked one about incorporation, and David mentioned we'll talk about incorporation toward the end. So maybe if we have some specific questions then on incorporation, that'll be great. For the time being, let's get back to a few more slides here.
Moving expenses. So really, there are some expenses that you can't claim. So if you're doing repairs to a house or a condo, or if you, say, bought a condo and lost money on that, you can't claim the loss. Folks going on house hunting trips, really, they're not deductible. And then this next bullet here is around going on a trip for job hunting or site evaluation. Really can't claim those as a moving expense either. So, or if I've had to move and replace, say, appliances, I really get nothing for that. So the tip here really is around my comments around
right.
the timing of a move. So, again, can have a pretty significant impact on your taxes.
Yeah, it's funny. That's one that I wouldn't have thought about at all. I don't know. I guess in my simplicity, I thought that there would just be a certain, like, how if wherever I lived the most that year, that's where I have to file or something.
Yeah, no, it's actually where were you resident on December 31st.
Wow, interesting. All right.
So again, folks looking to, say, reduce their tax bills. So a big one that a lot of folks are aware of is the RRSP contribution. So I have cash, I'm saving it for retirement, I can put that into a registered plan, and on my personal tax return I get a deduction for that. They limit the amount that you can contribute. It's 18% of your employment and self-employment income in the prior year. There's a cap of $26,230 for 2018 as your contribution limit. And the nice thing here is that, let's say cash is tight this year and I don't contribute, the unused room will just carry forward indefinitely, and I can use it in a year when my income increases and I have money to be able to do that. There's a deadline around contributions, so it would have just passed on March 1st, so on Friday, and it's basically 60 days after the end of the year I get my money into an RRSP and I can claim it in the previous year's tax return. Tip here is around if I do have significant self-employment income and you're concerned about the taxes, maybe contribute a portion of that to the RRSP. It'll help offset that income on your return. And another one I find a lot of folks starting out, and a new home purchase is on the horizon, and you're thinking about saving for a down payment, you can put money in an RRSP and then use it for the home buyer's plan. So I think the next slide I talk a little more about that.
Okay.
So what the home buyer's plan says is that you can use up to $25,000 from your RRSP, so I withdraw the money out of the plan, and I can use that to purchase a new home. They have some restrictions, so it must be that I don't own a home in the year that I'm doing this or in the previous 4 years, so they say you're a first-time home buyer. I need a written agreement to purchase the home, and I have to occupy it within 1 year of the date of purchase. And also, if I've used the home buyer's plan, say, for a previous home a few years ago, I can't have a balance outstanding under that plan. So basically, I take the money out of the RRSP, and then over time, I can put it back in. So it's a 15-year repayment, and it starts the second year after the year of withdrawal. A big one here that you want to watch out for is I can't just put $25,000 in the RRSP and then the next week go draw it out to use it to buy a home. It has to be in there for 90 days.
Oh, okay. Yeah, interesting. Maybe I'll just jump in for 1 second there,
Sure.
David, because we did have a question, and you had a couple great tips there, and this is more sort of an opinion question, but we'll get you to expand maybe on RRSPs for a second. Nadia also asks, at what point during residency should we start contributing more to an RRSP? Should larger contribution be reserved for when our incomes are higher as staff post-residency?
Yeah, so that's a great question, and I would generally say I would agree with holding off. So the idea here is that in Canada, the more income you make, the higher your marginal tax rate is. And in Nova Scotia, for income over $206,000, the tax rate is more than half, so it's 54%. And so let's say that, you know, I know in my future that I'm going to be in that tax bracket and I have RRSP room. You know, I have a choice. Do I use that room today, make a contribution, and let's say I'm in a tax bracket where it's 37%. So if I put $1,000 into an RRSP, I would save $370 on my tax. If I wait it and I use the contribution in a year when my income is well over the top bracket and I made that same $1,000 contribution, I would get a $540 tax savings. So, you know, again, by waiting, I can realize more benefit from having used the deduction.
Kirsten asks, if we didn't use an RRSP for our first-time home, is there still anything we can claim?
Not unless you sold the home, didn't own a house for 5 years, and then went back to buy another one.
Yeah.
So too late after that.
Okay. Back we go to tax credits.
Tax credits, yeah. So the point here is that tax credits work a little differently than a tax deduction. So the items we've been talking with before, they get subtracted from your income, and like the comment around the RRSP, the higher your income, the more tax you save from a deduction. Okay, the government looked at this tax system and felt like, okay, we're going to give everybody a basic exemption of $11,900, and they felt that everybody should save the same amount of tax because of that exemption, right? And so a tax credit, you receive this tax credit of $11,900, and they multiply it by the lowest personal tax rate. And whether my income is $12,000 or $212,000, I save the same amount of tax with a credit. Yeah, so here in Nova Scotia, a $1,000 tax credit would save you $238, right? And New Brunswick, the tax rates are pretty similar. Would save you $247. And so you can see here from the slide that the savings are less than a deduction. Yeah. For tax credits, there's a multitude of those available to folks. And a few years ago, the Conservatives, they liked the tax credits. They dropped little gifts for, say, tradespeople for their tools, or kids' fitness, or that kind of thing. Or back in 2008, to stimulate the economy, they gave you a tax credit to do home renovations. A lot of those have since expired, so there are fewer today than there were. And so some of the common ones that people need to make sure they claim is the basic credit. And so I can claim that for myself, and also for a spouse. If I had a spouse who wasn't working, I can claim a credit of $11,809 for that person. There used to be credits for kids, and those ended a number of years ago now, back in 2014. There's a Canada Employment Amount credit, and so basically they say $1,195 for everybody with a T4 slip, and that's the max. If I if my employment income was $1,000, I would only get $1,000 for a credit. Okay. Kids fitness and arts credits, those were killed off back in 2016, so we don't get those anymore. And the first-time home buyers credit, so that's a federal credit only, so there's no Nova Scotia tax credit for that. And so in that one, I get a 15% credit against my federal taxes. So it's a $5,000 tax credit amount. It saves me $750 in tax. And again, you have to be a first-time home buyer, which is, I don't own a home in 2018 or in any of the 4 previous calendar years. Big one for a lot of folks here, it's tuition credits. It used to be tuition, education, and textbooks. So what would happen is the university would give you a T2202A, and that would indicate the tuition that you paid and also the number of months that you were in attendance at the school, so whether full-time or part-time. And on your personal return then, you would get a credit for the tuition cost paid, and also for each month that you were a full-time student. Between the education and textbook credits, you would get $465 per month. So I would get this $5,580 credit each year. So that was killed off also. So, but that's a biggie for folks in residency, because the T2202A will indicate tuition, but it's a relatively small amount for residents. Like I think it's $2,300 or thereabouts. It changes a little bit each year. And so before I was getting this $2,300 credit for tuition and $5,500 credit for education. Now I just get the tuition credit, right? Nova Scotia still gives you a provincial credit for the education amount. So really the impact of losing that federally was about an $800 tax increase for folks in residency each year. If you don't need a credit, so let's say you're in medical school and you're building up tuition credits and you don't need them this year, I can carry them forward. Or if you had a spouse who had income, you can transfer up to $5,000 in the year to a spouse. Okay. Also, as part of the tuition credit regime, folks will have exam fees, so the Medical Council or the College of Family Physicians or Royal College. So those folks or those bodies will issue a credit saying that you wrote the exam, and they'll say here are the fees that you paid. So you get a credit for those fees. You get the credit not in the year that you pay the fees, but in the year that you sit the exam. And there's unfortunately no credit for if you did like a prep course or travel for that or travel to sit the exam. Here it's really only interest paid under a government-sponsored loan program. So people that have a student line of credit through the banks, there's no credit for the interest paid on those plans. But those plans still may be not a bad idea. And the reason I say that is, let's say that if I'm paying 6% interest on my student loan, and I get, I'll call it a 25% tax credit for the interest, really then by the time I pay that interest and I get a tax break of 25%, my interest rate is 4.5% effectively after tax. If the interest rate on the line of credit is less than 4.5%, I'd be better to forego the student loan interest and tax credit and use the line of credit instead. So again, something to think about there. And so rule of thumb is if the interest rate on the line of credit is 25% less than the rate on the student loan, start to think about that.
Okay,
great. Credits we'll often see, again, medical and dental expenses. These may be kind of hard for folks to get if you're relatively healthy and let's say have the couple of visits a year to the dentist and some prescriptions. The reason for that is, again, you guys have a good benefit plan for the members, and so a lot of the cost of those prescriptions and treatments would be covered, so it's really only the out-of-pocket cost that I'm entitled to claim as a credit. So To get more than $2,300 of that in a year may be difficult. And medications, I guess, if they need to be prescribed. So, certain, say, folks may have supplements or that type of thing. If they're not prescribed, you don't get anything for those. The practitioners that you can claim a credit on vary by province, and so the requirement is the person that I'm going to see licensed in the province to be able to provide that service. So the big example that we see is registered massage therapy.
Oh, okay.
So here in Nova Scotia, a massage therapist can practice without sort of being regulated. You can't get a tax credit for those costs, but in New Brunswick, I think Newfoundland, they are licensed, so you can get a credit in those provinces. So it doesn't seem fair, but that's the rules. And a few years ago, the government clarified that cosmetic procedures don't qualify as well, so nothing for those, unfortunately. The one thing I would say, though, is if you did have something significant where you did have high medical expenses in the year, it might be a good idea to say that if I'm going in big in the year in medical, I may as well do it all this year. So let's say that I've had braces, let's say, or my child had braces, and so the out-of-pocket expense this year was $6,000 or $7,000. Well, I've gone over that hurdle, and let's say they're done this year with the braces, and so next year, I may anticipate having some procedure done that is going to cost me. If I did it in the year where I'm already over the $2,300 limit, then I would get a full credit for the additional expenses. But if I put those off until the next year, I have to get over that $2,300 credit again, and I may not get any benefit. So again, if to the extent that you can plan for it, time as much medical to happen in the calendar year as you can.
I see.
Donations, a big one that we see again. And so a couple things to keep in mind here is that it's to a Canadian registered charity. We'll see folks sometimes donate to U.S. charities. You can get a credit for those on your Canadian tax return, but you have to have U.S. source income to do that. So again, a lot of people don't necessarily have that. So the receipt should indicate a CRA charity number. A big one that we'll often find people will send in is, say, the QE2 home lottery. Right? So they say, I bought these tickets, but again, it's a lottery, not a donation, so you don't get anything for those. In terms of the tax benefit that you get, it's 24% on the first 200 of donations. For anything more than 200, it's 50%. And to the extent that my income is over 206,000, so a portion of my donations, I can get a 54% credit then. So they basically prorate the donations for that credit to the same extent that your income was over the 206. And so tips here, again, make donations within the same year. So I'm going to give $200 in December and plan to give $200 in January. Do them both in December, get the higher credit. And the other thing that happens is with a spouse, you can pool the donations together so that only one person has to get over that $200 credit before you start getting the 50% credit. A few years ago, they had an extra credit if it was the first-time donor. But that's since expired as well. That's gone. Yeah, they're making our job a lot easier. There's not nearly as many credits.
Yeah, I feel like in my head, it might be easier to combine all of your charitable giving into 1 year versus your medical expenses. That might be a little more random.
Totally. Yes, exactly. Don't see this one a lot, but when you do, it's pretty valuable. And so basically, it's somebody has a prolonged and severe impairment, and that it restricts their activities of daily living, and so whether it's speaking or hearing or vision or walking or mobility, that kind of thing, you can apply for the disability tax credit. And So the interesting thing here is that if you have a child with a disability, you can apply for the credit for the child and then transfer it to your return.
Okay.
So don't see it a lot, but when you do, it's pretty significant tax savings. The other thing here is that the credit eligibility has been expanded. So you'll see things like a credit for folks with celiac disease. Let's say you have credit now for if you need a service animal, let's say, to help you, you can get a credit for the cost of that, for the care. And if you needed to modify a vehicle, you can get a credit for that. So they've generally been expanding the disability tax credit to more and more conditions, I guess.
Okay. Well, maybe we'll just take an opportunity here to reset again, David, as we're coming up on the bottom of the hour. For those of you who have joined us, thank you very much. Welcome to Mardocs Talks Live, and this time around we're talking tax tips with David Hall of Flaim Wolsey Hall, and we've got a lot of questions in the queue, but we've got room for more. We'll probably keep going maybe up till 8 o'clock, hard out around 8 o'clock. That'd be an hour and a half, but certainly fire away those questions if you have them. You can just type them into the chat, or you can email me directly, daniel@mardocs.ca, and I'll be checking both places. Also, if you joined us late, there's prizes tonight just for joining us. You get in on a draw for 3 $50 Visa gift cards. So to be sure that your name is in that draw, just type your first and last name into the chat. That's all. You don't need to have a question. Just fire your name in there, and we'll use that to make our draw later on. While we've got a little break in the action, why don't we talk about a few tax credit questions that have come up. So Nadia asks, can you get credit for application for assessment of training, i.e. application to the RCPSC to be able to write our final exams? If so, is that applicable to the year we write the exam to?
So generally, you'll see people, like, you'll make a couple of payments to the Royal College before you sit that exam, and what they will do is they'll track those payments, and it's really not up to you to figure out the amount. You get a letter back from them saying that you've paid, whether it's $4,500 in fees or something like that, and that it's eligible for the tuition credit. So it's really dependent on what you get back in that letter.
Okay, great. We've got another question here that says, if, for example, when we finish residency, we don't have a health plan and end up paying $24,000 a year for prescriptions, how much can we reasonably expect to get back on taxes?
So in that case, let's say you're totally out of pocket, and you would have the $2,300, so you don't get any credit for that. And so now I have $22,000 of out-of-pocket medical, let's say, and I would get a credit for, call it a quarter of that, so around $5,000, maybe a little more. Okay. So that's the credit there. Okay, great.
Daniel asks, are continuing professional development courses eligible for tuition credits?
Generally not. We don't see that. It really would be the tuition credits are from like a university or some other school, so they'll issue the T2202A. So if you don't get that, you're really not able to claim a tuition credit for those costs. Having said that, though, if you do have, say, self-employment income and you're doing continuing courses or continuing professional development that way, we will claim those against the self-employment income.
Okay, great. And Ollie asks, on some online tax programs, it will allow you to transfer $5,000 federal and $5,000 provincial. Is there a max of $5,000? Are you wasting $5,000 if you transfer both?
Is that around tuition, I'm assuming? I think
there's a little lag, of course, in at least a 30-second lag up here, so we could ask Ollie to specify on that. But if it's tuition.
If it is tuition, no, it's not wasted. So basically the tuition, if you had the tuition on your tax return, you would get a 24% tax credit, right? So and that's federal and provincial, so it's 15% federal and call it 9% Nova Scotia. If I transfer that $5,000 of tuition to a spouse, they get the same 24% credit. So there's nothing being wasted or lost as a result of the transfer.
Okay, great. I'll keep an eye on that, and we're on the home stretch here for our presentation, so let's get back to that.
Quick ones here. We don't see a lot of them, but again, I don't know if anybody in the audience would have a spouse who's a school teacher. We get a credit for supplies in the year. Folks looking to adopt, there's a credit amount of up to $15,905 per child adopted. You can claim things like adoption fees, court costs, legal expenses. So not a huge one, but again, every now and again you'll see somebody who's looking to adopt. And home accessibility. Again, this one's really geared to assist people to stay in their homes safely. And so, I'm over 65 where I'm eligible for the disability tax credit. And I can claim up to $10,000 a year for costs to allow me to stay in my home. Tax rebates, these were a great thing a few years ago. Basically what would happen is like a tax deduction, let's say you would save 40% of the deduction amount in tax. A credit, you save 24% of the credit amount in tax. The rebates, it was a full dollar. And so Saskatchewan, Manitoba, New Brunswick, and Nova Scotia all had some form of graduate retention rebate. The only one left now is Saskatchewan. So if you get a job in Saskatchewan, I guess, good on you. And so you have up to 10 years to claim that. I think a few years ago when Nova Scotia looked at it, they really felt like they looked at the data before and after the credit, and they didn't really see any impact in terms of graduate retention, so they canned it. Yeah. Towards the end, so professional corporations here. Really, I think folks in their last year of residency want to start thinking about this. And generally, people will finish up in June and start working shortly thereafter. And so generally I find that, people are pretty occupied with trying to study for exams and sort of get that behind them. And then you have this sort of maybe 6 or 7 week window, or maybe 8 weeks before you've done your exam and I'm done the program. That's the time to go see an accountant and really start to think about how I transition from residency to practice. Okay. And generally what I find is, there's lots to think about there. Your income goes up pretty significantly. So really critical that you have a good sense of, okay, what is my tax obligation going to be here? So I know with us, we'll meet with people and really try and map out, like, okay, what do you think you're going to make? What do we think your expenses are going to be? And here's what we think your tax would be. Oh, you have RRSP, so we'll use that this year, and really come up with almost a budget for your taxes so that when tax time comes, you're not surprised. Okay. In terms of incorporation, I find now it used to be a no-brainer, not so much anymore with the tax changes that the government brought in at the start of 2018. Okay. So back in the start of 2018, the government said, look, people are getting a big benefit from incorporating, from income splitting with their lower income family members. Because again, if I'm making $300,000, that dollar that I'm making, the last one is 54% tax. If I could take that dollar and give it to a family member, they may pay 24% tax. So, what we found was savings from income splitting for a couple with one of the spouses not working was around $27,000 or $28,000 a year. So, and then the other benefit that people would realize from incorporating is corporate tax rates are about a quarter of what a personal tax rate is. So the idea would be I make income, I don't need it to pay lifestyle expenses or repay personal debt. I'm going to put that in a company and pay 12% tax rather than 54% tax. The money that I need to take out to, to make my sort of lifestyle work and repay debt. I will pay personal tax on that, but the rest of it I can leave in my company. And so, you know, really at the top bracket, I get to hang on to an extra 42 cents of every dollar I make. It's not that that tax is saved, but it's deferred until I take that income out at some point way in the future. And I can put that money to work and invest it for me for perhaps 20 to 25 or even 30 years, depending on how long you work. And that was, you know, again, a pretty big benefit from incorporating. In 2018, the government brought out rules to put restrictions around income splitting. So they basically said the family member has to actually work for the practice, and they have to work 20 hours a week year-round, so 1,000 hours a year. So we generally found that difficult to do for a lot of folks, especially if, you know, it was a specialist going to the hospital and perhaps with an admin person there. So there really wasn't a lot of work to allow someone to income split. And around the using a corporation to defer tax, they brought in some rules. They're fairly complicated that look at, you know, I've built up money in my company, and now that money is generating interest and dividends and capital gains. The government looks at the amount of that investment income, and if it's more than $50,000 per year, the rules are designed to make you pay more corporate tax than that 12%. So there is a benefit, and what we're finding is there are ways around the impact of the passive income or investment income rules. But you know, again, what I find for folks is if you're coming out, you know, you've got large RRSP carry forwards, you're not comfortable with the debt, and you want to be fairly aggressive to pay it down. Essentially, at a point where I want to save, and I want to save way more than I can in RRSP. That's when we think it makes sense for people to look at that.
Okay, great.
Yeah. But, you know, again, I go back to the transition from residency to, you know, practice. Those are conversations that everybody that comes in the door, we want to take the time to figure out, okay, what is your situation here? And then decide, okay, does it make sense to incorporate or not? And you know, whatever way you go, then we want to guide you and make sure that you're not going to get into trouble from a tax perspective, at least in the first couple of years. So, you know, we hate to see people come in the door who've been out working for a year, you know, had a great time, and you know, we say you have a tax bill of $140,000 and they have no money. So yeah, that's a difficult situation. So
Definitely.
Do our best to avoid that.
Absolutely, for sure.
A couple other points here, just going back to the discussion around the RRSPs. So there are other ways to save on a tax-deferred basis as well. So, you know, most people have heard of a tax-free savings account. They work a little differently than an RRSP in that you don't get a tax deduction when you make a contribution. So if I put $1,000 in, there's no impact on my tax bill for the year. But the income that I earn inside the tax-free savings account, there's no tax on it. When I take out my original contribution and the investment income, it all comes out tax-free, and I can recontribute the amounts I've taken back out. So with an RRSP, once the money comes out, unless it's something like a home buyer's plan, there's no way to get it back in. But with a tax-free savings account, you have that flexibility to do that. If you are putting money in and out each year, you really got to watch the limit, because some folks may say, you know, I had 20 grand in there and I took it out and I put it back in, and I did that a couple of times, let's say. Every time you put the money back in, it counts as a use of your contribution. So you could go over your limit for the year, and then you're into a 1% per month penalty. Now, the money that you do take out, you can put it all back in the next year. So your withdrawals one year sort of add to your contribution limit the next. Okay. And the tip here is, if I expect my income will go, if my income is low now and I expect it to be higher in future years, consider using a tax-free savings account, because I can basically, I have flexibility to put money in or out. I can grow the income tax-free, and then let's say now in the future year when my income is higher and I have RRSP contribution room, I can really take it out of the tax-free savings account and put it into the RRSP, and then get that maximum benefit from using the RRSP.
Okay, great.
Registered savings plans, so again, RESPs for people that have kids. These are similar to a tax-free savings account. You don't get a deduction for them. There's a $50,000 contribution limit. There's no tax on the income earned inside the RESP, and the government will give you a savings grant up to 20% to a max of $500 per year for your contribution. So if you put in $2,500, the government will throw in another $500, so you get $3,000 going in there. If you've not been able to use room or make contributions in a year, and you have sort of grant room available to carry forward, you can get up to $1,000. So you can put in $5,000 and then get $1,000 in that year as a bit of a catch-up. There's a $7,200 lifetime limit to the grant, and I hate to think if my kids did this, but they can be students until they're 35. So it's one thing to go to medical school and that kind of thing, but another to be a permanent student. But so really, you have flexibility in terms of when you can use it and when you can contribute. And so again, want to try and maximize the grant if you have kids. And when the time comes that you want to access money out of the RESP, you do get a tax slip for that, but the tax slip is issued to the student, and you only the original money that you contributed can come out tax-free to the student. The grant and the investment income is taxable, but generally what we find is, again, if I'm taking it out and using it for tuition, I have tuition credits that I really don't pay any tax on that investment income.
Great. All right, and I guess we're right at the end here. So let's move on to questions, and we'll take one last opportunity to reset here with about 7:45 now. So I'm here with David Hall of Flaim Wolsey Hall, and we're answering all your tax tip questions. You just saw a great presentation, so much information when it comes to taxes, and yet every slide seems like it's got great information on it. So if you still have questions after seeing all that, just fire them away, write them in the chat, send me an email, daniel@mardocs.ca. I'll be checking both. We're going to lightning round here and get through as much as we can in the next 15 minutes or so. Also, if you joined us late, don't miss out. We're going to have a prize draw for 3 $50 Visa gift cards. If you want to get entered in that draw, all you need to do is type your first and last name into the chat. Fire it in there. We'll use that as the draw later on. Probably do that offline since we're pushing so late now. I've got a question here from Ollie about TFSA, so maybe we'll go with this one since we were just talking about that. Hypothetical question: if you put $25,000 into a TFSA, you do well in the stocks, and you take out $150,000, can I add $150,000 back into the TFSA at a later date?
Yes, you can.
Okay.
That's my dream, to actually pick a winner like that in a tax-free savings account. So I can. My 25 turns into 150. I can pull that out, and then in the future I can put the 150 back in. Not in the year I did it, but in the following year.
Okay, great. So I'm going to process through some of our email questions here, and I'll just give you full license here, David, to, if you think we covered something, you can just really short answer it, but we'll just use this as an opportunity to cover a lot of things here. Here's one that came in earlier this week. It said, I know that residents in other provinces get a T2200 from their employer outlining the type of expenses that a resident can deduct. I contacted NSHA, and they said as of 2017 they don't issue them. Where can I find this information? Is there some other organization, like such as Dalhousie, or?
So that form really has to come from your employer. So Dal, unless you're an employee of Dal, they're not going to issue one of those to you.
Okay.
And I think it was the experience around the CRA denying everybody's cell phone back in 2016 that that practice more or less came to an end. You can still get that form though for other types of expenses. So again, if I had to travel and I have out of pocket and it was part of my duties, I can get that form and claim those expenses.
We talked a little bit about this, but maybe you could just bottom line it. Explain the difference again between a tax credit and a deductible expense. Is there a difference there?
There is. So a tax deduction makes my income smaller. So for a dollar saved in my income, I save whatever my marginal tax rate is. And so the higher my income, the bigger the benefit from a deduction. A tax credit is, no matter my income, I get the same tax benefit, and it's basically the tax savings are the lowest tax rate applied to the credit amount.
Going back to tuition, how do tuition credits work? How do I apply my tuition credits? Does Revenue Canada automatically apply them, or is there something I should actively be doing?
Yeah, they will not automatically apply them. So when you file your return, you want to claim those. If you're using tax software, basically the software will do the thinking for you and will claim the tuition credits if it makes sense. So they'll basically claim the credit to the point where my taxes are zero, and then it'll stop claiming, and then it'll carry that forward. And so there's a couple of forms that you would use. There's one provincially and one federally to claim those. And but if you're using software, it'll take care of both.
Okay, great. All right, here's a question about locuming. I've been locuming over the last year, and I'm wondering what can be deducted from taxes, i.e. hotel receipts, meal, gas bill that pertains to locum. We talked a bit about that.
We did, yeah. So the thing here is, you want to think about, I'm doing that locum, and really I'd rather you say, okay, this expense, it's connected to my locum. Like, I'm paying that out of pocket to be able to go earn that income. And so keep those receipts. So again, travel, if you had extra dues, accommodation, meals, like all of those, want to track that, and then give it to us. If we never get it, we don't know about it and can't claim it for you. And so again, really the rule of thumb for me is, when I'm making that payment, am I doing that to be able to earn that self-employment income?
Okay. Here's a question about lines of credit. For those still making line of credit payments, is there any advantage to not having taxes deducted each pay in order to apply that money to the line of credit?
That's not what I see often, I guess. Again, if you're disciplined enough to be able to use the money to put on the line of credit, I guess, then I'd say go for it. That may work for a couple of years. Generally what you'll find is, if you file your tax return 2 years in a row and you owe more than $3,000, then CRA is going to come looking for what they call personal tax installments. And to manage that, I would think it would just be easier to say to my employer, withhold the pay from my income, and I won't have to deal with those tax installments. So you could end up in a situation where, let's say I've reduced my tax at source for employment income, and I've done that for a couple of years and I've owed, and so now I'm in a situation where I need to make installments and I don't really pay attention to that, and CRA will charge you interest for a missed installment. Okay, so the issue with that is the interest rate that CRA charges is going to be more than the interest rate on your line of credit. So you would have been better off just to have had the taxes remitted for you.
Great. The last few years I've had a company complete my taxes. How much time should I schedule if I want to complete them myself? And is there an easy to use reference document that can show me how to do it?
I would say, in terms of time, it really depends on your situation. So again, if you don't have significant medical and I just have a T4 and I'm not moonlighting and maybe a couple of donations and a tuition slip for something, that return, maybe an hour to do that if you're doing it yourself. In terms of how to do it, what I find is that could be a tricky thing to sit and read.
Yes.
If you were to, a lot of software now would almost use like an interview type of interface. So it will go through and start asking you questions. Does this apply or not? And it would walk you through the process that way. So that probably would be, if you are going to be a do-it-yourselfer, the way I would go about it is, use an online service or buy the like TurboTax for your computer.
Okay, great. So here's one about cell phones. We talked a lot about the CRA and their cell phone stance, but this particular question wants you to forecast a little bit. Do you think this is likely to change their stance on cell phones? For many residents, a cell phone is necessary for work.
Short answer is no.
Yeah.
No, I think now that they've made that known, and A, you'd have to convince your employer to give you that form, and B, you'd have to run the gauntlet of CRA review to try and get that. And like I said, they were pretty effective at catching everybody a couple years ago.
Another question on tuition tax credit. I have bank tuition tax credit, which has been carried forward from prior years. When claiming the bank tuition tax credit, how do these dollars reduce the tax and influence your return? In other words, is each dollar of tax credit going to reduce my tax by $1, or is there another ratio?
Yeah, so again, it goes back to the idea of tax credits. So you would get a benefit of 24% for Nova Scotia, and most provinces would be pretty similar to that. So, if I'll see people finish medical school and first year residency, they'll often have tuition carry forward amounts of anywhere from $60,000 to $100,000, let's say. And so we'll claim as much as that as you need to get rid of your tax, and again, you save 24% of the amounts that we use.
Yeah. Great. Another question here: Can non-Canadian exams be deducted? Example, the USMLE.
Short answer again is no.
Yeah.
And so the exams, you would tend to get a tax credit for those, and it would be the body that's you're administering the exam. They'll give you the letter saying that you can get a credit. Some folks would try and claim it as a deduction, but I don't think that you get too far with that.
I have a couple sort of similar questions I'll just lump together, talking about tuition tax credits and RRSP contributions, and basically asking the same thing. With all of these ways to reduce our taxes, is it best to use them during residency, or should we hold on to them for when we're an attending physician and our income is much higher? Is there a general rule of thumb there?
Yeah, so again, with the I'd sing a different tune on the credits than I would say a deduction. And the reason I say that is whether I use a credit now when my income is $75,000, or 5 years from now when my income is $225,000, I get the same benefit. So you're better to save the tax today than to wait. So for credits, I'd say use those as you need them.
Here's a good one that you might be able to shed some insight on. What are common things that residents sometimes miss claiming on their taxes, or don't even know that they could claim? Is there anything that comes up across your desk a lot when you're talking to clients?
I find that I don't often see that, because the folks that we prepare their taxes, we send out an organizer ahead of time, and so it's a 3 or 4 page document, and it probably has 50 or 60 items on it that say, did you have this, do you have that, so it really goes and meant to trigger people for different types of deductions and credits that they can claim. Tricky one, I guess, that people tend to struggle with is around the self-employment income, and again, what expenses do I need, and perhaps they haven't really done a good job at tracking those through the year, and then at the end of the year it's sort of a big task to try and sort that out. So I find that that's something that people are generally relieved to be able to get help with.
For sure. So we're down to just our last few questions, and they're almost all related to the tax prep side of things. So we'll start with this question from the shadows here. Say someone has had their taxes done by some unnamed large accounting firm for several years because they do it for free, and then they decide to no longer do it for free. Does that someone have to collect anything in particular from that firm to then take their taxes somewhere else, or are they good to go?
Yeah, I find generally you don't have to get anything from a firm if they've just been doing your personal tax. I know with our firm, if anybody gives us any documents, we return them all, like all of your source documents, when the return is done. And there's not really anything to give back to you. If somebody has moved, for example, let's say, and they want a copy of their return, we'll gladly give that to people. But that might be the only thing. And I find now even that is becoming less and less important because, let's say there was a tuition carry forward or RRSP carry forward room that, you want to know about when I'm preparing this year's taxes and I haven't done the return previously. Most of those things now, CRA, you can log into the CRA website and look those up. So for us, it's really a little bump in the road in terms of trying to move forward with somebody if they don't have a previous year's return.
Great. I'm going to backtrack for 1 second here because I did miss one question about the credits again. Can the review courses for the Royal College be claimed as continued professional development with self-employment? They do track your attendance at the courses for the CME credits.
Yeah. Again, I see people with self-employment income, and so we will look at claiming those as a deduction on the self-employment income statement. Okay, great.
So then, again, back to the tax prep side of things. I've got 2 questions about your firm specifically, but first the question is, what is a reasonable fee to have someone do our taxes at this point in our career? And maybe I'll also double barrel that with what's the benefit of having a large company do your taxes versus an individual accountant? The floor is yours.
Reasonable fee. I look at people can go a couple of different routes. Bigger firms and CA firms in general will be more costly than, say, a sole practitioner. The reason for that is, again, there are systems and quality control in place that you may not necessarily get with a single person doing a return. For us, we offer a discounted rate for residents, and so, we say it's $75 per return, but if you've been a resident with us, say, for 5 years, and we've done your return and a spouse's return, so it's $150 a year, all of the $750, if you decide to work with us after you're done residency, we'll credit your account for the first bill after you're done residency. So really it's like a no-cost option for folks in the long term.
Great.
Firms I think generally do want to work with their returns.
Okay, great. Well, and the last 2 questions were both the same. They were asking specifically for your firm, what it would cost to have tax return done, and you just kind of mentioned that. And we also usually send out an email after this, letting people know where they can watch this afterwards, if you'd like to see it a second time, and include a link to David's firm as well as that deal. So I guess with that, I see no other questions in the queue, and we have just passed 8 o'clock, so I think we'll probably wrap it up there. Maybe just I'll turn the floor over to you, David. Just any other final thoughts? Is there anything that you think we may have missed? And there's also sort of this vague question that I did get about what can we do as residents to maximize our tax efficiency. So maybe just sort of, are there any big tips that we should be walking away from this presentation from? What's the highest level?
I think the key thing I go back to, make sure you file your return on time every year.
Yeah.
Like that's the main thing. I find if that gets away on you, people can get behind and get in real trouble. And if you're not sure, go to somebody that can give you a hand. It's one thing for folks to try and guess whether I get a particular credit or something is deductible. And if you guess wrong and include something, CRA will come back and disallow it, charge you some interest. But if you don't know that I should even get something and I miss that, then CRA is not going to come and say, oh, by the way, you didn't claim that, right? So then it's money lost.
Yeah.
So, we do see folks do their own returns for the at least first years of residency, and then if people get into a situation where I have self-employment income, then they may need an extra hand. Again, early years, if I just have a T4 and not a whole lot going on, some of the tax software seems pretty reasonable in terms of walking you through that process.
Okay.
Yeah, again,
Great.
it's again, look for help if you're not sure.
All right. Great. Well, I just want to thank you, David, for tonight, for coming out and for helping us and for partnering with us for all these years. I know I'm not a physician, and a lot of this doesn't apply to me, and I still find this a very interesting session every year. There's so much information and a lot of misinformation that we get to correct. So I really look forward to this one. Thanks very much for your time.
That's good. It's a pleasure. And again, if anybody has questions after, or they think of something after the fact, just reach out to us, and more than happy to give you a hand.
Great. Thank you. And one final thank you to you folks for taking a minute out of this March evening to get all boned up on your tax info and to join us once again for our Mardocs Talks Live. I do have a full list now for everybody who has joined us live. If you're listening to my voice right now and you haven't written your name into the chat box below, please take a moment and do that. And I'm going to do a draw after we shut down, because we're now well over an hour and a half, for 3 $50 Visa gift cards. And we're going to hand those out. I'm sending out an FYI either Thursday or Friday, so look for that. And I do want to thank you for joining us. So for one final time, for David, for myself, thank you. Have a great evening. We'll see you next time.